evening, everyone. It's Roger Phipps, and it's another week of UBT Live. On this week's show, we are super excited to bring Brody Vinson, another UCF alumni, to the show. And as you remember, I am founder for Seven Lights Marketing, Bird Eye Boo Inc., Boss Leadership Solutions, and a bunch of other businesses that we'll mention throughout the show. I'm also a consultant for everything business, leadership, ops, and tech. So super excited this week. It's episode 16, believe it or not. And for this week, we're going to be talking about exit strategy, something people don't typically think of when they're starting a business, but sometimes you have to think of the end while you're starting the beginning. So to help us understand that, let me go ahead and bring in the boys, and then we'll bring in Brody. So for those of you who know my good friend Josh Lazar, welcome back to the show, Josh. We've seen each other twice in 72 hours to do a show, so super excited about that. A little bit different topic. Alan Levin, let's welcome Alan back to the show, founder of Smarty Pants with a Z Marketing, although I'm not seeing a Z tonight, so I don't know what's going on there, Alan. And then last but not least, we're bringing on star of the show for this week. Hey, there he is. And last but not least, we're bringing in the star of the show this week, Brody Vinson. Welcome to the show, Brody. Super excited to have you.
Thank you guys for having me. I don't know if I've ever considered myself a star, but I'm happy to be here regardless.
Well, tonight you are the star, unfortunately. You're also the SME or subject matter expert, since we love our acronyms around here, on exit strategies. So we're going to get a little bit of information from you on that. And then we're going to also hear your UCF journey. And you had another business before the one that you currently run. So we'll talk a little bit about that and the lessons that you learned from there. So welcome to the show. And let's go ahead and get started. So number one on the list, I think it would behoove us to explain what kinds of exit strategies there are, and what does that actually mean? Because a lot of business owners don't think about that when they're starting their business, or at least their first one. They usually think about it on the second or third one, but not their first one. So Brody, can you kind of give us an explanation of what an exit strategy is, and when people should start thinking about one?
Sure, I'd be happy to. The first thing that I would say, you're hearing me all right, right?
Yep.
You're good.
The first thing I would say is that there are a lot of different types. They could be very creative and they range a lot. I would classify all exit strategy or exits into kind of two main categories, though. One's where there's kind of a full handoff immediately of the business and it's fully prepared. And then one's where it's a little bit of a structured thing over time. So I like to just kind of categorize them into those two things to keep it simple. And this might look like someone from inside the company taking ownership and buying the company. It might look like a larger company buying the company to add to their portfolio, or it might just look like someone like a private equity investor adding it to their overall portfolio of companies. So there's a lot of different types. To answer your question about when you should start thinking about your exit strategy, the honest answer is as soon as you start a business. Everything that you do as a business owner should be targeted at an exit, whether you plan to or not, because ultimately at the end of the day, planning for an exit just creates good business. It's one thing I talk about a lot is that owners who do not plan for an exit, it's really just not the ethical choice for the business, because if anything happens to you, if life happens to you, in other words, which it always does, something could happen to the business and cause things to fall through. There could be a contract that doesn't get done on time or some project that falls through the cracks. Anything can happen if the business is completely dependent on you. And if you're not planning for an exit, you're really not making yourself removable from the business. So also two main different types of business owners. There's really what you call like a lifestyle business owner, where they live and breathe the business. Every client talks to them and only them, and they don't really remove themselves from anything. And then there's value builders. So value builders are focused on addressing the areas of the business that need to be addressed and just creating what we call enterprise value of the business. Enterprise value simply means, what is the business worth on the open market to the right type of buyer? And so when you're planning an exit, you want to be thinking about every facet of the business through the lens of the enterprise value and thinking about how you can increase that. So there are about 25 different things that I like to really coach on with business owners that help add that enterprise value.
Yeah. So, it's funny that you mentioned dependence on people, because we talked about that last week, actually, on our five mistakes to avoid in business ownership, which was one of the big ones, was creating dependence on yourself. Now, we didn't use it in this context per se, right? But again, it's another theme that you see over and over and over again, and a mistake that business owners make all the time. So it's interesting that it was brought up in the context of this, but it also, and something I'd like to kind of expand upon, that you brought up, was for owners to think of another kind of exit, which is an exit where they are setting up that value because they want to step out of the business, right? So out of the day-to-day running, and use their time to do something else, and maybe switch to an advisory type of role, as opposed to being a CEO, right? So, starting to think about your business as an asset, right? Like we do with your personal portfolio, thinking about your business as an asset, and even products at a product level, or if you get large enough, a division level, as an asset that could be spun off. That's another way that we could be thinking about exit strategies, because the exit could be, hey, this is the primary thing we do, right? We have clients, we have a product, we have whatever that's really our marketable value. It may not be a physical asset, right? That we need to be thinking about that. And I think that strategy of understanding, okay, what is the asset value that you're building from the beginning, right? Is it the technology that's proprietary? Is it the assets that you're bringing in based on revenue and retaining earnings within the company, right? Is it do you have a super fast growth strategy? So it's really your client base, right? Are you penetrating a market and you're making yourself valuable because you're stealing a bunch of clients from the market and your market share is the value, right? Or is it just that you're a big enough disruptor in the industry that somebody bigger is going to want to come and cash you out? So, there's a whole lot of different ways to look at this. And I think most people, small value, like small businesses, some people go as a startup and they want to be a software company. So they know they're going to disrupt the market, right? But then there's the small businesses that are starting like, hey, I'm passionate about this. I'd like to do this for a living. And since I'm doing this for a living, like, how they don't envision themselves stepping away from the business. All they're thinking about is, hey, I got to make this thing run. If I make it run, I'll worry about that later. So for those small business owners that start that way and maybe catch fire, or may not be one of those 100, 500 billion dollar companies or a unicorn, which I'm hoping to build a few of. But if you're not that, and you are that small business that's never going to get outside of your local region or your local county or multiple counties, like, how should they be thinking about this?
Well, I'll start with why, actually. I think the why is important to understand what they should be thinking about. The why is that you can simply, by thinking this way and by taking the actions that create exitability, so to speak, you can keep yourself doing the things that you actually love about the business. So if you love being on the sales calls and talking to clients and helping, things like that, but you hate the operations, if you're building operators and putting operators in place, you can focus on the things that you actually love doing. And the reason you should do that is because it's going to create sustainability for you. There's pretty shocking statistics when you look into it, about just how many small businesses fail and how quickly, in such a short period of time. And it's because you start this thing with a passion, but you don't realize how much you're going to burn out if you just dive in fully and you don't create any kind of removability for yourself. So that's the why. The what is just thinking about the things that are consistently burning you out, the things that you hate doing in the business, no matter how passionate you are, how much you love doing this thing, how important the business is to you. There are going to be things that you hate doing in it. That's just the life of being a business owner. And you should start with those things, because to create that sustainability, you've got to be able to hand those things off. The difficult thing about this is to be able to set that up, you have to start really documenting the way that you do things. So creating things like standard operating procedures, documented processes and procedures of the way that you approach different scenarios. This could be as down to the nitty gritty as creating very detailed sales scripts for the way that you approach clients. If you don't really like getting on sales calls and making sales, you could put a salesperson in place, but they have to know how to sell your product or your service to be able to do that. And oftentimes that takes a lot of hand holding. A lot of people are not willing to go through the difficult process of doing that hand holding. So if they do bring on someone to try to service the need that they have, a lot of times they think it's not working out just because they're not really putting in the work on the front end to set them up properly. And so you've got to be thinking, what are the things I can document? What are the meetings that I can have, the shadowings that I can do to make sure that I'm setting up this person for continued success in this position that they're filling for me? And just first of all, having an idea what the position is that you're filling. A lot of people hire someone, a lot of business owners will hire someone just because they think they need that position. For example, you might just think that you need an HR manager. And a mistake that I've seen people make, and this has happened in the company that I had that I think we'll talk about, but it happens for a lot of business owners, is just being told that you need a certain position or thinking you need a certain position and going and just finding a job description for that and putting that out. In reality, you're hiring for a specific need in your business. So you should be creating a very detailed job description and communicating that when you're doing the hiring that actually reflects the needs that you have in the business. The reason for that is, first of all, it's going to outline the position in a more realistic way for the candidate, so they'll know if it's a good fit, more than just saying, hey, I need an HR manager. I've seen that you're an HR manager. You have been in the past, so I think you're the right fit. If you actually approach it through the lens of what your business needs, then they'll be able to understand more whether it's a fit, and you'll be able to better instruct them on how to handle the position.
Yeah, so like one of the things we've talked about in the past was hiring practices and interviews and things like that. And, I think the feeling generally is if you get to the point where you've got the interview, your resume looks good enough that you probably have the skills to do the job. So the question is more, the questioning should be more around fit with the team and the culture. And then also, that specific unique need. So there's a lot of, you're right. A lot of companies don't highlight that. Or it's lost in the rest of the job description. And, from a candidate's perspective, and I know we're kind of going off track here, but like from a candidate's perspective, it's important for them to know because they have to highlight in their resume how it matches up. So, specific things that you're looking for, you may actually be missing out on candidates because you're not identifying them, right? Or identifying what you need from that candidate and highlighting that appropriately. So it's interesting that you brought that up. Going back to, your business strategy and developing one, what would you say the key elements are that you should incorporate for your exit strategy specifically? What things should every exit strategy consist of?
The biggest thing I would start with is making sure, well, let me back up a second here. The first thing is understanding what your actual end goal is. Is your goal to get the most money that you possibly can in the exit, or is your goal just to exit and get a decent payout for it and just kind of escape the business? And people approach this from a couple different perspectives. It kind of just depends where you're at in your journey, whether you're starting the business with the purpose of exiting, or you've just decided you need to move on because of things that are happening in your life. So you've got to understand your goal first. And then once you've identified your goal, you could just start kind of moving towards that and taking the actions that actually draw you there. And I would say the number one thing I would start with is, if you do want to make a full exit and not a structured one, is you need to put management in place. So you need someone that can actually handle the actual management of the company. So operations is one thing, accounting is another, finances, all the little things that have to be done. If you yourself are running around handling those all the time and you don't have good managers in place, you have to do that first. So I would start there. The other thing is packaging your financial statements in the right way. So you've got to think about the big three. There's the balance sheet, the income statement, and a statement of cash flows. These all kind of tell the story of the financial state of the business in a different way. That's all important to showing the big picture. And a buyer is going to want to see that those are well structured, well updated, that they match what they're seeing on transaction records, and that that's well reflected. Another really big thing is a buyer is buying your business ultimately for what they believe it will do in the future and not what it's done in the past. So you have to really be thinking about a future growth strategy when you approach this type of thing, because if you're not able to communicate the way that you expect the business to grow going forward, then the buyer is not going to be confident in the fact that it will grow as an asset. And typically they're buying it not just so that it can bring in some money and do what it's done historically, but because they believe that it will do more in the future and that it has growth potential. And a good place I like to start with this is something called the Anzoff matrix. It's essentially a set of 4 quadrants that helps you guide your growth strategy and pick a quadrant to grow into. It's essentially, you've got at the first rung, you can focus on your existing product and your existing market. That's usually the place I would instruct any business owner to start, is creating a plan around how can I get my best performing product or service to more of the same type of people that I'm already serving, because you probably haven't tapped out that market yet, and you could probably create a plan around that. But then of course you can bring your existing market a new product, or you can bring your existing product to a new market, or you could bring an entirely new product to a new market. So create a plan around that and just be able to communicate that to a buyer so that they understand why it's going to grow.
So, if you're going after like seed funding or something like that, right, I would think that that would be a good thing to have in your back pocket then as well. And not everybody who starts a small business is looking for funding, right? They're starting with one business, they grow fast. All of a sudden they're opening up multiple locations or franchising or doing whatever. That's a different thought process than someone who's looking at raising capital and moving fast, because then you start introducing a concept like multipliers, right? The other part about it is as you're thinking about your assets and where your value is on your balance sheet, and what the value of your business is, that's also going to affect your ability to lend later on, right? So if you need cash to expand or do whatever you need to do, it serves a dual purpose, not just for your exit, but also it's a good thing to do so that you can equip yourself to be able to go get any type of funding, which includes lending, business lending, and things like that. One of our new partners, this is something I kind of teased over the past couple of weeks, Rock Financial, is someone that we're working with now that looks at that non-traditional, non-banking model, right? So that banking model relies on personal guarantees and credit scores and things like that. And one of the things you want to do as a business owner is position yourself so you don't have to personally guarantee those loans in case something does go sideways. So there's a process to do that. And anybody who's interested in the non-guaranteed lending, we have in our description, there's a link there so that you can reach out for that type of help as well. But I think and I feel like what you kind of described is basically do a really good business plan in order to prep it, right? And then the exit strategy is going to influence your business plan. Because if I'm going to go out there and I'm going to raise capital, and my thought process is whether I go VC or anything else, if I'm going to go and raise that capital, I'm going to dump that capital and use that growth for the multiplier, because there's value in that in day one and day 35 later on as well, right? So I think that's super important to what you're looking to do. Josh, I've kind of been manipulating the show so far, so I want to give you an opportunity to ask any questions around the topics that we've started so far. So, exit strategy, when to plan it, what elements of the exit strategy?
Well, I'll go right off the top, and that's something we talked about a little bit before the show, is sometimes that there's something called a pre-mortem, like in project management, the idea of like, how will this fail before you even get started? So you figure out how you go forward and not fail. So when it comes to exits and strategies, everything I'm hearing is everything that I've expected, which is wonderful. Maybe I've learned something through my business time. But my question to you, Brody, is how not only should you do it, but what's the best way to plan for exits, either selling or this isn't working, when you have multiple partners? This is maybe even like, let's just say 3 or more, even though I have my ideas on businesses with 3 or more people. But how does that kind of factor in when you have maybe more people than the solopreneurs, or maybe 1 or 2 people?
So Josh, to add on to that, are you talking about established businesses, or are you talking about at the front end?
I'd say twofold. One, at the front end, 5 people have an idea. Again, maybe another conversation on maybe that's too many, right? But at the beginning, how does that look like? What does that feel like? Because the people who are starting businesses that are listening to this that don't have established businesses might want some insights, because as Roger said earlier, not everyone thinks about the exit when you're starting a business. So I'm really geared towards that. But if you're also established and in that growth pattern, and it's multiple people, what does that feel like in your experiences?
I'm so glad you asked this, Josh, because this is something I have really personally experienced. The last business I was in that I exited, there were 4 of us at the beginning, 4 of us at the end, a different 4 at the end. But I can speak to both of those things. And I'll start with on the front end. If you are getting into business and you're considering getting into business with partners, the first thing I tell anyone in that position to do is create a partnership agreement. If you haven't done that yet and you're starting things in the business, do it yesterday. It's so important. I got this advice when I was starting the business, and we still didn't do it fast enough, but it's kind of the folly of having, blind goggles on and just being ready to rush ahead with this exciting idea that you have. Take a step back, get a partnership agreement in place, because the business is not set up to succeed if you don't have the same expectations. And the first thing about creating a partnership agreement is that it's just a great exercise in actually figuring out what everyone's expectations are, whether it be their own roles and the duties of the actual position, the position that they're going to fall into itself, the exit strategy that they have in mind. Not everyone's going to have the same picture. You have to be able to get on the same page to create that sustainability and success. And so I would start there, create the partnership agreement. a cool exercise that I just took an early founder through recently, actually, someone that I just connected with through actually one of my professors in my UCF MBA program, cool enough. So shout out Dr. Tim O'Brien for making that connection. He connected me with a founder that is starting a company with a few others. And what I told them to do is what I just told you about, is create a partnership agreement. And they were a little unclear about what exactly everyone's roles and responsibilities are. So he had asked me, what should I do about that? And what I told him to do, because everyone kind of just imagines that you go into a business and you automatically all have an equal share, and that's just how it works. And that is what it defaults to, but that doesn't mean that's how you have to actually approach it. If you have 4 people starting a business and 3 of them are going to be full-time, and one of them is going to be putting 10 hours a week or so in, but it is an important 10 hours and you do want them there and having some ownership, then you should probably structure it such that they own a portion that's a little bit smaller and is meant to actually reflect what they're bringing to it. And so if you go through the exercise of actually outlining every role that you expect to need to be filled, every hat that needs to be worn as one of the business owners, and you start assigning those roles and those duties to each of you and giving them weights. This is what I told the early founder to do, is give each duty, role, and responsibility a weight, 1 to 10, score it, and then assign each of them to your various partners. And by the end of it, you're going to end up with a pretty good structure of how you should actually split the ownership. You can always adjust that if you need to. A partnership agreement, I like to say, is a prenup for your business. So it basically takes into account what is the worst that can happen. Like you said, what is the worst that could possibly happen? And how do we plan for that? How do we expect that to happen? How do we plan for it? So just really taking a lot of time on that. First of all, we'll tell you whether you really should be starting this business with these people. And second of all, assuming the answer is still yes, which hopefully it is, it tells you how you should actually be structuring it. So this is something I really wish I would have taken more time on at the beginning of the business I was in, because we did run into differences of opinions on the exit itself and the way that everyone's roles and responsibilities should be. And things got tricky. There was difficult conversations that could have been avoided with a little bit more pre-planning. And to address the other part of your question, which is how does that factor into the exit? If you have a partnership agreement already, great. If you don't, go back and just go ahead and create one if you haven't yet. And even if you are deep into the business, just have that conversation, really sit down and take the time. If you have the partnership agreement and you're thinking about the exit, just really have a long conversation with all your partners about what you actually want and figure out whether they want to stay in the business if it gets acquired, whether they want it to get acquired, what everyone's ideal outcome is, and what the amount of money actually is.
Yeah. So one of the things, depending on what type of business you set up at the front end too, is going to dictate that. Because some businesses, you outline all that in the bylaws, and depending on the structure of the business that you have. So like, for example, in mine, we outlined not only, the shares and what people can do, whether they can borrow against them, whether they can, because, it's like Elon Musk. He doesn't make a salary, right? He just borrows against his shares, and then they're worth more and then he just pays it off, right? So there's never any tax paid. I mean, it's genius, but the rest of us are paying a little more for Elon, but it's genius. But being able to dictate those things in there, what people can do with the shares, how they can pass them along, all of that stuff can be done in the front end. In those bylaws. So that's another opportunity outside of a partnership agreement. But I feel like that exercise that you're talking about is the important part here, whether you canonize it in the bylaws or the partnership agreement, that should be done on the onset. And it also allows you to dictate when you're building shares or raising funds, what the thought process is behind that. I know I talked to you about this, Brody, before. I mentioned on the show, but I'm going to mention again, anti-dilution clauses are key for you, because you may start off with 20% of the business, but if you go raise your first round of capital and you don't have that set up properly, all of a sudden, the capital is raised, you don't have 20% of the business anymore, right? So the anti-dilution clause protects you because the number of shares that are issued, you have to be issued a corresponding number of shares, so you don't lose ownership of your company before the end of it. So, and that's especially important with VC. That's why VC won't touch people with anti-dilution clauses. So, okay, I'm gonna be quiet. I know that Josh had a follow-up, so I'm gonna let him go.
Yeah,
go ahead, Josh.
This is great to hear the interplay between different people's experiences. It's what I love as a part of this podcast and live stream. And as a listener, hopefully you're getting these different insights and these different backgrounds. Because I have a great story about why I'm never going to go into business with more than 2 other people. So anyway, back to the actual story, Brody. I noted that you were a file clerk in your resume, and it's someone who's been in legal technology for about 18 plus years. Legal is something that I'm very attuned to, and I'm married to a lawyer, so that helps as well. You were talking a lot about partnership agreements, but are you putting this by an attorney before you're all said and done, or not?
100%. You have to. If you're not running it by an attorney, first of all, you're not going to think of everything. I would honestly consult with multiple attorneys if it's within your bandwidth, within your budget. Even I would even go so far as to say have each partner have their own representation if it's within your bandwidth and within your budget again. But at the very minimum, absolutely have it reviewed by an attorney, because you could have, a partnership agreement could be a Post-it note with everyone's name on it and a number with signatures at the bottom, or it could be a really well-structured, documented thing that is a culmination of one or multiple attorneys' bodies of experience that they bring to the table. And ultimately, the better and more comprehensive it is, the more possible situations it covers that you have not seen before, but that you will see. And so if you have someone with that body of experience, or maybe the firm behind them to give them that body of experience, vis-a-vis their kind of templated agreements and things, then you're just able to cover way more bases that you would not have thought of otherwise.
So one, I agree, right? And the times that I've had to do this, I've done that, and now I go solo for the most part. It's not always the best thing. We already talked about this on the live stream, but I want one last follow up, and I'm wondering if you have some insights about people who are bootstrapping, because I know we're going to get into investments and in just a little bit in investment pitches, and we already talked about that in some areas. But for bootstrappers, for people who are just doing this on their own, whether it's by themselves solo or with others, how important is an exit strategy? I'll say, 1, if you're solo, and 2, if you're with a partnership, if you do not intend to take funds.
I would say it's equally as important. And actually, me and my partners in the previous business bootstrapped our entire business. And I won't go too deep into the details of this, but at one point we lost most of what we had saved up. And we had to start over from scratch essentially, and bootstrapped that. And it's so important because, again, just going back to how I kind of started off the show, building for an exit is just good business. It creates the frame of mind that builds the type of business that is worthwhile. And I'll flip it over for a second. One thing I like to talk about doing is just having empathy for your ideal buyer and thinking about what they would be thinking about if they were looking at your business. You want to be thinking, if they came across my business, would this be a valuable asset to them? And the reason it would be valuable is just because it's a good, well-run business. So if you start thinking that way, whether you envision an exit or plan an exit or not, the way that you will build the business is just, it's a better, more profitable, smoother business.
Cool. So since we're kind of touching on all this in all of our conversations, let's go with exit strategies and investment pitches. So one of the things that's important if you are going to raise capital or seed funding or anything like that is to make sure that in your, you have a pitch deck, number one, and you have a one pager. And what the one pager basically does is it tells people, investors, because it's all about networking and getting your stuff in front of the investor. You don't want them looking at your pitch deck that's 13 slides, 14 slides with all the deets. You want something that's going to summarize what the business does, where the revenue is coming from, what your mission statement is, who's involved, those sorts of things in 1 or 2 line sentences. And an important part of that is also the exit, right? What does your exit strategy look like? Because the investor wants to know what that exit strategy is going to look like as well, as to when they are going to be able to extricate themselves for the business, or when you plan on doing it so that they can take more control over the business as well. So there's that aspect of it. And that timing is going to be tied to how fast you grow. Now, most investors are also going to be looking at this. On average, they're expecting, if they're an angel or something like that, they're expecting a 26% return on their investment. 26% is their number, right? So when you're looking at how many shares that you're offering to do that as part of that exit strategy and how you're controlling those shares, it's important to know that as well. And disclosing that on the front end makes it look more attractive to those individuals, because you've actually thought this out. A lot of investors go into this and they're just looking at stuff and they're like, okay, I got this great idea and this is what I'm going to do. But for an investor that's looking at your business, they want to know you don't just have a great idea and how to execute on that, but you've thought about financially the business aspects of it, because a lot of people are missing on that. So from your experience, how important are exit strategies and investment pitches? And, what kind of advice would you give to folks on what to include, what key talking points to include in either their pitches or their one pagers to attract those investments?
Well, I would say transparently, I said I bootstrapped the other company with my partners. So that's a little bit more the realm that I come from. But I would say a lot of the same principles apply as far as the reason you want to communicate your exit strategy, like you talked about. The things I would be thinking about are a lot of the things we've talked about already for a one pager or kind of a summary or a pitch deck. But the reason you want to communicate your exit strategy is because it allows just more transparency between what your intentions are with the business, and they could begin to reverse engineer what they want to get out of the business from what your ultimate goal is, and they can understand whether it's a good fit or not. If you lead with the exit strategy and the plan that you have to get there, you might rule out some investors that aren't the right fit, but when the right one does come along, I think they see that and they're able to really understand what it is that you see coming out of this and whether it's the right fit for them.
Cool. I know Alan's just jumped back in. Welcome back to the stream. He had the same issue I had the other night with our sister stream. Where I dropped out. Alan, did you have, I know you kind of missed some things here. Did you have any questions or anything regarding exit strategies that you've kind of thought of or wanted to ask?
Yeah, sure. So Brody, have you found, when it comes to, I know we were just talking about like one pagers and pitches, have you seen anything like unconventional or creative that maybe makes those a little bit more memorable instead of, kind of the same kind of cookie cutter approach? Have you seen anything that's really stood out or anything you've heard that's, made something a little bit more noticeable?
I would say one thing that can really make you stand out is having supporting market data. If you really, really go out of your way to collect legitimate supporting market data that actually backs up your idea, you can't really get any more clear with the value that you're communicating than showing that it is backed by the market. So I would say if I were trying to get someone to really stand out, that's what I would kind of lead with, is how can you collect proof that this concept works and be able to communicate that.
And if that market data is not out there, one of the things you can do is at least communicate the opportunity, right? So what the market size is, and take a conservative number of that market. Like normally, if you've got 2% market share, you're doing really, really well. If you got 10%, you're blowing it out of the roof, right? But realistically speaking, you can say like easy digestible numbers like per 100,000 users or whatever, and generate and translate that to a number. And that way you can say, okay, if we do get 2% of the market, which is, an industry average type of goal, this is what you should expect for that revenue. So that's another way that you can do that if you don't have uber detailed market specific data like that, or it's a new thing that's hitting the market, right? All right, so kind of transition. Oh, go ahead.
Sorry, I didn't mean to interrupt. I just wanted to add one more little note there. I was kind of thinking through this through the frame of something new to the market or something a little bit different. I would say any kind of survey data that you can collect, and if you go out and do interviews of your ideal persona that would be buying this thing, that goes a really long way. And if you might rule out the idea of it even working well, but more so just having supporting data for product market fit, I think, is really important.
Awesome. That's great advice too. All right. So, we're thinking about exit strategy. We kind of covered, the ideal situation, which is you've thought about this up front. You've created your exit strategy. Any partners that are involved, you've told them how much they're going to get, or you've agreed, right? How much they're going to get. But there are situations where, you've established your business or you've added partners, and you didn't think about that exit strategy. So what should you do if you have an established business and now you want to think about an exit strategy and what that looks like? What things should you be evaluating to decide what that looks like? And then also, once you've decided what that looks like, what tools are there to kind of help people build out those exit strategies? And I'm kind of teeing that up for you.
Yeah, absolutely. I'll start with the tools question. 2 assigned readings I would give someone in that position are one, Walking to Destiny by Christopher Snyder. This is written by the founder of the curriculum for the Exit Planning Institute. So this is kind of a generally accepted curriculum that's used to coach upcoming advisors and that are helping people with exit planning. So that's a really good one. Another one that I like maybe even more is Built to Sell by John Warrillow. That's a really, really good book. And essentially, to give you an idea of what to expect from that book, it's told through the lens of a fictional owner of an advertising firm who has not been able to create any kind of removability for himself from the business. And so he wants to sell it, but he doesn't know how. And so he starts trying to go to people to get him to get help to actually accomplish this. And he ends up finding a family friend that's a very accomplished entrepreneur who's built and sold multiple businesses. And this guy coaches him over the course of, I want to say, a couple of years on how to prepare for this exit. And it's fantastic. It just shows you a really inside perspective of what you should be thinking about. And it's told through, like I said, through this lens of an actual story. So it makes it stick a little bit more. So I would start with those. The other thing I would do if I was an established business owner starting to think about this is start talking to brokers, business brokers, have all different types of specialties and connections. They have the inside track to what is working and the types of deals that are being made in this world. Brokers and M&A advisors, mergers and acquisition advisors. And if you talk to some of those people and just tell them, hey, I am a business owner who's thinking about an exit one day, and I'm just curious whether you have experience in this industry, whether you've seen deals like this in this industry. I might be looking at going through a broker one day, and I'm just looking to get a little bit more information about what I should be considering, how I should be setting myself up for this. They can give you a pretty good track or a pretty good plan of the types of things that you need to address, and you can share with them where you're at currently as a business. So those are the types of people I would be going to. I would also be just making sure to match up your expectations with the reality of your business. So when you are going to those people, you've got to kind of have an idea in mind of what you would like to sell for and under what terms. Are you willing to stick around for a while and see the thing through? Do you just want to completely hand it off? And what are you willing to accept there? So you could communicate that to them and see if that aligns with where you're actually at and what types of multiples they're seeing in your given industry. It's going to be different across different industries. So going to brokers is one channel. I would also just do some research on sites like Biz Buy Sell, other kind of brokerage sites for businesses, and just see if you can find any data about similar businesses or businesses just in the same industry as the one that you are operating in that have already sold, because that can allow you to, again, kind of track back and see what types of things they had in place that might have gained that value for them.
Awesome. So I'm going to open the floor to Josh and Alan real quick. Did you guys have any other questions that you had for Brody?
Oh, it looks like we lost Josh.
Yeah, I don't know what's going on. Maybe he was so excited about the question that he was typing something in and exited out. Alan, did you have anything else?
Maybe you already talked about this, but do you advise at all, like, on what to do, like, after the sale and kind of like what happens, after everything kind of, moves forward, and kind of just what it looks like after that? Is there anything that they should be prepared for, anything like that?
Well, the first thing I would ask about that, I would say, if they're after the sale, it's going to depend on whether they're staying in and they have kind of a structured exit plan that's going to occur over time and slowly be removed, because some look like that, or whether they're just completely out of the business. I mean, the biggest hurdle I faced having exited my business earlier this year is, what do I do now? What's the next step? What do I do now? And so if you're in that position and you're completely out of the business, I'll just talk about my own personal experience and what I did. I like to call it my time in the desert, is just figuring out what are the skills that I've accrued over time doing what I've done, and where do my passions lie? What am I passionate about, and how might I merge those two things to take me to the next steps? And for me, I had gone through this rigorous process of my exit and learned a lot about what to do and what not to do from selling two businesses in a short period of time. And I had the skill of being a podcast host myself and interviewing people and being able to kind of probe into the types of information that allow you to discover important things about a business. So I just decided to merge those two and be able to help business owners find what they want. And it just took a lot of introspection on my part, a lot of really thinking about what it is that I wanted out of my next chapter. And a lot of times when you've gone through something as big as an exit, it allows you to kind of take a bigger perspective and think about what is the actual goal that I have for my career, and where would I like to see it go next. So I would say, for someone in the position of being completely out of their business, I would just spend a little time in the desert figuring out what it is you want to do with your next chapter. For someone that's still in the business and has kind of a structured exit plan, I would just encourage them, don't get senioritis. Don't stop doing the important things that you need to do to make sure that your business is running properly, because you had this buyer acquire your business or buy your business for a purpose, and they expect something out of you. So I would just really make sure to have structured and continuous conversation with them about what their expectations out of you are, and let that guide your process. And also just have continuous conversation with them about how they want you to build yourself out and the order that they see you doing that in, and what works best with their strategy.
Makes
Awesome.
sense.
Yeah. So like this was our last topic. We'll talk about UCF last, but what do you have any like exit lessons that that you have that you would pass on to folks when exiting? Just if you want to encapsulate like 5 or 6 lessons that you took away that you wanted to share.
Yeah, I'll just kind of fire them off here as they come to me. The first thing that comes to mind is just stand strong in what you want out of the exit, and have talked about that with any relevant stakeholders or partners beforehand, because a lot of times these things happen unexpectedly. It actually did for me and the company I was in. The buyer came unexpectedly. So you've got to be prepared and have talked about this with all of your partners, just standing strong and knowing what you want out of it. There was, a lot of things happen when an exit is on the table, and if you aren't prepared to stand strong, then you might not get out of it what you're looking for. The second thing, just preparing for it, is I wish that I would have documented our points of value along the way a little bit more, because there's so many things happening in a business, and you don't even necessarily think of the actual value of the business, of the asset itself, most of the time when you're in it, because you're just thinking about growing it. But documenting the actual points of value and the things that you believe make it valuable or big. Another one that comes to mind is having your customer data really well organized. I've personally experienced a business, the business I sold before this one, that I ended up with after my father passed away. The customer data was kind of all over the place and wasn't really organized, and that made things really difficult. That was an important asset that wasn't able to be represented well enough, just because it wasn't organized well enough. So be thinking about all of your customer data and how it can be well organized into one place.
Awesome. Great advice. So for the listeners out there, since this is a UCF themed show, tell us a little bit about your UCF experience, and then the best memory you have and the craziest thing you did while you were at UCF.
My UCF experience is still ongoing. Luckily, I'm in my MBA now, but I did my undergrad at UCF as well. So graduated back in 2019, and it was intense and incredible. From the football perspective, my freshman year at UCF was the year that we went 0-12. So I got here and I was like, did I pick the wrong school? What's going on here? I didn't know. I came here expecting some awesome football to be happening, and we're going 0-12. But then my sophomore year, we got a little bit better. And then my junior and senior year were the 2 years that we went basically undefeated in a row. So it was a wild ride and lots of ups and downs there. I was fortunate enough to be involved in Greek life at UCF and got to experience that. That was a really great time. And I made a lot of incredible connections and got to get really involved with the school. So I highly recommend that if you are a UCF student or considering UCF. And then now I'm in my MBA program, and that's been incredible as well. It was really important to me to be, if I was going to get my MBA, to be in a program where I was able to attend in person and really get some hands-on experience and feel like I was learning a lot from the professors. And I can honestly say that's been the experience at UCF. In the MBA program, I'm in the professional MBA program. And pretty much all of my professors so far have just come from really deep corporate or business or entrepreneurial experiences themselves. And so they're able to provide a lot of real world experience to the lessons that they teach. So it's been incredible so far. And I finished that up in spring and looking forward to that. I'd say the craziest thing that I did while I was at UCF is get a ticket to go up to Atlanta and go to the Peach Bowl when we played Auburn. And that was incredible. Just, a complete long shot. No one knew if we deserved to be there, and we proved that we did. And it was incredible.
Did you go to the game day experience when it was on campus in 2018?
I did. Yeah.
Did you stand in line, and were you like, or did you come later on? Because I mean, it was packed to the gills. I was there with my son, so it was absolutely nuts. But there were a lot of students that waited to get in the stage portion of it for a very long time the day before.
I didn't get to stand in line and wait for that. I came a little bit later on, but I talked to a lot of people who did, and it was a crazy experience. None of us could believe that they were actually coming to UCF at the time, and it was a surreal thing to see.
Oh yeah, absolutely. So best UCF memory.
I would say best UCF memory, probably the Peach Bowl that I mentioned. Maybe the whole process around it too. That I did wait in line for. So we were given the opportunity to buy, I think, a $50 student ticket for that game. So I waited in line overnight, starting at like maybe 7 p.m. or something, and just camped out until 7 a.m. with a bunch of my friends, and just waiting in line for that, and then experiencing the game, going up to Atlanta with a bunch of friends and getting the shirts and being in the stadium and seeing that happen was incredible.
So
awesome.
I was going to say, quick question, just a quick callback. You said you're in the professional MBA program. Two things. One, can you describe that a little bit more? Because it might be a little different than what other people might know as an MBA program. A. B, did you go on your trip yet?
My trip yet?
Yeah, the professional MBA trips, sometimes they have trips with your cohort.
So that's actually the executive MBA. That one's a little bit more hands-on. I haven't obviously personally experienced that, but I've heard that's great as well. I think the way that they structure that is it's a little bit more intensive, and so it's just meant for a little bit higher level, more experienced executives that have been in their career field for maybe 10 to 15 years plus. So I haven't personally experienced that one, but I know they do take a trip for that.
Yeah, that's what I meant. You're good.
Yeah, so I'll say this about the executive MBA program. That program is less about learning the skill sets from all of the various things. Like when I went through and why I chose the professional MBA, I was already in leadership at a Fortune 500, right? But I chose the professional MBA because I didn't have a full grasp at a C-suite level of what all of those other individual pieces did, right? So I didn't know from an accounting perspective what they did. I knew accounting, right? But from a C-suite level and the drivers of those financial statements. So I took the professional MBA path, the executive MBA path. You don't get that. It's more about leadership. It's more about driving change. Like you get driving cultural change, you get leadership, you get organizational behavior at a C-suite level in the professional, but it's primarily focused on that. So, for those of you that want both, or that are middle or like executive leadership but are trying to get to C-suite, I think the professional MBA program is a better route for that than the executive, but that's just my 2 cents.
And knowing that there's two, yeah, right. That I don't know if a lot of people know there are multiple MBA experiences, not only UCF but other institutions. That was something new to me. It was so new that I forgot which one he was on.
Yeah, my experience with the professional MBA has been similarly great. It's like Roger was saying, it's just a really holistic view of all the different areas that operate in a business. So I would say that as someone who's been in a leadership position for a while now as well, I found that it gave me the ability to kind of envision the business more as a whole and understand what drove each thing. And also, if you see yourself as a leader who's going to end up bringing on people to help you manage a business, it helps you have the foundation to understand whether there's someone capable and there's someone that is doing a good job at what they're supposed to be doing. It helps you understand enough to be able to manage and find good talent, I think.
Awesome. Okay, so I think that should wrap that up. We've had an hour of great conversation. It's actually our longest. Well, no, it's not. Second longest interview, because Jesse, I think, went like 2 hours.
Yeah.
Jesse Wolf from Odang, he went 2 hours, and that was enlightening as well. But I really just wanted to appreciate and tell you I appreciated you coming on, and obviously give folks an opportunity to know how to reach you, and then what your current venture, what that's all about. So if you'll share that with everyone.
First of all, thank you again, all three of you, so much for having me. It's been a real pleasure and an honor to be on here and share some of my experiences with you. And I hope the audience found some value. If you are looking to find me and just get a little bit more information about what I do, best places to find me are Instagram. That's at brodyvinson.io, just first name, last name.io. And then YouTube, I put out a lot of my podcast interviews on there. I do a TikTok as well. I put out short form content on all three of those. So you can find me anywhere on there, but I would say if you want to message me, Instagram. And what I do now is the program is called Scale for Sale. So it's essentially a lot of what we talked about on the episode today. It's exit planning, advising. So I do one-on-one coaching with a business owner who's identified that they would like to exit or become acquired. And I help them create a plan around that by addressing the gaps that they currently have and systematically helping them add value to each of the core pillars that I coach on.
Awesome. Well, like I said, you've been a wealth of knowledge. I think some of us are more, one of the beautiful things about this show is some of us are more knowledgeable about a lot of these things than others, right? Because we've experienced or got a little more experience. Josh has a different experience level than what Alan does with different aspects of this and what I do as well. So I think the value add here for you that you brought to the table is you're taking those lessons learned from an exit and empowering people on the front end, with that knowledge, because it really was valuable knowledge. So we've got a few things that we've got to finish up here. Thank you so much for coming in. We'll obviously be in touch as well. And I guess have a great evening, and maybe there'll be an opportunity later on for you to join us again.
Absolutely. You guys have a great evening as well. And thank you again for having me. I look forward to staying in touch.
All right. Thanks, Brody.
Thank you.
All right, boys, what do you think? Are we prepared for the exit in the beginning now?
No.
No,
but yeah.
Yeah. He had a lot of good information.
Oh yeah, and truthfully, there's a lot of the times where you know what you're supposed to do, and even as Brody was saying it, but are you doing it right? And myself, like I know what I need to do. I am solo, but still, I should be thinking more and doing some other things that I'll definitely take from that. So yeah, the answer is it was wonderful, because it's not only it's great new information for some of us, maybe all of us, and definitely for the listeners. It's at worst case scenario, it's a reminder, right? It's a reminder of what you should be doing. And sometimes you just need one sign or one podcast or one live stream to give you the reminder of things you already know you're supposed to be doing. So that's kind of what I took away from it. Am I ready? Probably not. But this should be the reminder to go, yeah, there's some things you need to figure out.
Awesome. Yeah. So speaking of figuring things out, we want to continue to remind folks we've got GoldenKnightsClub.com out there. So if you're trying to figure out a way to connect with other knights and drum up some business, remember to visit us on GoldenKnightsClub.com, where you can list yourself and what you have to offer, and also search what other folks have to offer to help you find other Knight alum who can provide those services for you and continue to support. Alan, did you have any other closing thoughts?
I mean, I love when, people that come on the podcast, or when you're trying to educate someone and they can provide really just actionable insights and not kind of just, gray area that's strategy, but he gave some really good black and white tips, whether it's, having, creating SOPs for your business, whatever the case may be. So I thought it was a really impactful hour.
Yeah, I thought it was interesting too that a lot of our past shows they get woven into different topics that you wouldn't necessarily think are complementary, but it's good for me and validating for me that I think that the more people that we bring on that are talking about these things, the lessons that we're sharing and that we're imparting kind of dive into and mesh with what our folks that are joining and their experiences are. So you never know, all these things we're telling you guys, we're not just telling you to sound smart. We're telling you these things because they really matter, and they weave into different situations in your business career. So with that being said, I think it's time to end our podcast. We're at 106:43, so we're going to go past 107 because Josh's last question there at the end. But Josh, why don't you tell people where they can find you and what you do?
So you can find me at techthinktank.com or Tech Think Tank on LinkedIn, or Josh Lazar on LinkedIn. The core of what I'm doing is providing services for technology and trying to make sure your technology and operational strategies are aligned. So if your projects and technology are just kind of happening in your organization, and your operational goals are just happening in your organization, and for some odd reason things aren't just connecting up, or technology isn't doing what operations wants, or operations doesn't understand what technology wants, that's what you need to call us in for. So we'll do cloud lifts, and we'll do a lot of assessments and the knowledge and figure out how to make things work well for your organization. So yeah, Josh at techthinktank.com. That's and the Golden Knights Club website we talked about. Maybe we'll get Brody on there next, and just hoping we get some business done by the end of the year there as well.
All right, awesome. Alan, where can people find you and what do you do?
Hi, everyone. Again, Alan Levin with Smarty Pants with a Z Marketing. We help you optimize your marketing, maximize your budget, and get you those results you're looking for, whether it's brand awareness or lead generation. You can find me at smartypantsmarketing.com. Email is alan@smartypantsmarketing.com, or I'm very active on LinkedIn. So I'd love to connect and, talk some marketing with you.
Awesome. Thanks, Alan. And for all your marketing needs in small business, legal, medical, and higher education, video production, post-production, commercials, and all of the above, you can reach me at r.phipps@sevenlights-agency.com, or visit our website. Or for any of your consulting needs, you can reach me at bossleadershipsolutions@gmail.com. You can also reach me there if you need some help getting financing for your business. Again, great show, guys. Thank you so much. The details on the lending are down in the description. Remember to like, subscribe, and grind.
We're still doing the post thing, right? Where I talk before we end.